Hello traders, investors, and crypto enthusiasts. Welcome to our channel where we bring you in-depth analysis, breaking news, and reliable forecasts about the blockchain universe, Web3, and digital money trends. Today we will talk about a statement that divided opinions in the crypto market. The statement by fund manager Cathie Wood, CEO of Ark Invest, that only three cryptocurrencies, Bitcoin, BTC, Ethereum, ETH, and Solana, SOL, are sufficient to build wealth, has sparked intense debate in the market. ETH as the engine of decentralized finance, DeFi, and SOL as a symbol of explosive growth in NFTs and memecoins. However, critics argue that ignoring emerging sectors like AI tokens, DePIN, decentralized physical infrastructure, and stablecoins may limit unique value opportunities. The discussion reflects the eternal tension between security and innovation in asset allocation, while Wood advocates a lean portfolio based on historical resilience and liquidity. Experts in niche technologies emphasize that projects in AI, real-world asset tokenization, RWA, and decentralized networks could offer exponential returns, especially in bull cycles. The core question is, does focusing on giants reduce risk or limit growth potential? To answer this, one must analyze each asset's fundamentals, the role of altcoins in the ecosystem, and regulatory trends shaping the crypto market's future. Additionally, macroeconomic factors such as global inflation and interest rate policies influence the dynamic between reserve assets like BTC and utility tokens like ETH and SOL. Finally, the sector's inherent volatility demands not only strategic choices, but also rigorous risk management, including stop losses and weighted sector allocation. Fundamentals of the three giants and their technical outlook. Cathie positions Bitcoin as the most secure and transformative asset, highlighting its resilience since 2009 and potential appreciation of up to 15x over the next 5 years, driven by ETF adoption and global demand. Her argument rests on three pillars. One, digital gold, with a capped supply of 21 million coins, making it a hedge against inflation. Two, security, as Bitcoin's blockchain has never been hacked despite 51% attack attempts and manipulation efforts. And three, institutional adoption, with futures ETFs already holding $60 billion in assets under management, AUM, led by firms like BlackRock and Fidelity. Ethereum, meanwhile, dominates the DeFi sector, where over 70% of protocols operate, including Aave, Uniswap, and MakerDAO. Its real-world asset tokenization, RWA focus, projects like Realio, RWA, and Frax Finance, algorithmic stablecoins, rely on Ethereum's infrastructure, solidifying its role as the world's decentralized computer. The recent US approval of ETH-spot ETFs in July 2024 attracted $30 billion in institutional capital within 2 months, reinforcing the narrative of ETH as a layer one asset with a deflationary economic model via fee burns, EIP 5059, and staking, projecting passive returns of 4% and 6% annually. Solana, Wood's wildcard surprises with memecoin growth, platforms like Pump, Fun, and Jupiter Exchange fueling thousands of token launches, generating $1.2 billion in monthly volume. Its Durango upgrade, March 2024, boosted network capacity by 300%, making it ideal for scalable apps with fees at 0.01 and $65,000 transactions per second, TPS. Critics, however, question whether this focus overlooks promising niches like AI and DePIN, which have already shown exponential returns. Projects like Render, RNDR, Akash, AKT, and Helium HNT are redefining technological and physical infrastructure, while real estate tokenization via realty and art digitization through known origin democratize traditional investments. Ultimately, does concentrating on a few assets ensure safety or risk missing opportunities? Emerging sectors and the need for sectoral diversification. The stablecoin market, valued at $250 billion, is considered crypto's backbone, offering liquidity and passive income via protocols like Ondo Finance, which pays 5% annually in USDC/USDT. These assets also bridge DeFi and the physical economy with initiatives like tokenized government bonds and real estate. AI tokens like Render, RNDR, and Akash, AKT, gain traction by integrating distributed computing and decentralized infrastructure. RNDR, for example, allows artists and companies to rent processing power for 3D rendering and AI model training, while AKT directly competes with giants like AWS and Oracle, offering decentralized cloud solutions with strategic partnerships. Decentralized physical infrastructure DePIN networks like Helium, HNT, are redefining mobile internet and IoT, expanding into 5G and mining mobile and IoT. Real-world asset tokenization, RWA, also advances. Platforms like Realty enable property investment with $10, and Known Origin digitizes artworks, democratizing collectibles. Projects like Frax Finance and Monerium convert government bonds and obligations into stablecoins, integrating DeFi with traditional finance, yet many investors hesitate to expose their portfolios to these sectors, fearing uncertain regulation or low liquidity, while ETFs for BTC and ETH reduce legal risks in the US. Altcoins face scrutiny, such as the SEC classifying ETH as a security. However, history shows that niches like memecoins and NFTs, initially seen as speculative, became billion-dollar markets, suggesting that ignoring innovation can be as risky as betting on low-potential projects. Allocation strategies, safe concentration, or speculative niche exploration. Two paths emerge for investors: betting on the three giants or exploring high-leverage niches. The first strategy prioritizes security, with heavy allocation in BTC, ETH, and SOL, supplemented by stablecoins to protect against volatility. A practical example would be Bitcoin, 40%, store of value and inflation hedge, leveraging futures ETFs and adoption by emerging markets. Ethereum, 30%, exposure to DeFi and RWA with staking generating passive income. Solana, 20%, leverage in memecoins and NFTs, capitalizing on technical efficiency and growth indexes like Jupiter Exchange. Stablecoins, 10%, protection against volatility with yields in DeFi protocols. The second, more aggressive approach involves sectoral diversification. Bitcoin, 30%, safe haven with reduced allocation to free capital for altcoins. Ethereum, 20%, DeFi and RWA access but less weight than the conservative strategy. Solana, 15%, participation in memecoins but limited exposure to the sector. Promising altcoins, 30%, AI tokens, e.g. RNDR, DePIN, e.g. AKT, and NFTs, e.g. Blur, targeting undervalued sectors. Stablecoins, 5%, liquidity to seize volatile market opportunities. The choice depends on the investor's profile. Beginners may prefer the simplicity of the three giants, while experienced traders target niches like AI and DePIN, which surged 400-800% in 2024. Volatility also demands constant portfolio adjustments with quarterly rebalancing to avoid overexposure to a single sector. Tools like stop losses and hedging options, e.g. covered calls, help protect gains in both strategies. Finally, geographic diversification is critical. While BTC and ETH ETFs are approved in the US, regions like Europe and Asia are accelerating RWA tokenization and stablecoin regulation, opening new markets for global investors. 2025 scenarios. Where are the greatest opportunities? Predicting crypto market movements requires analyzing optimistic, realistic, and pessimistic scenarios. In the optimistic scenario, giants dominate. Bitcoin, BTC own, hits $1 million with spot ETF adoption and demand from countries like Argentina and Nigeria, where inflation exceeds 100%. Ethereum, ETH, rises to $50,000 with ETF approvals and RWA expansion such as tokenized bonds and fractional real estate. Solana, SOL, reaches $300 with ETFs approved and memecoin growth via platforms like pump.fun. In the realistic scenario, giants grow, but niches surprise. BTC tests all-time highs, $150,000, $180,000. Post-US elections and potential interest rate cuts, ETH hits $8,000, $10,000 with staking in ETFs, but faces competition from layer 2 networks like Arbitrum and Optimism. SOL rises to $250, but AI tokens, e.g. RNDR and DPIN, e.g. AKT, exceed expectations, surging 300–500%. In the pessimistic scenario, a broad correction creates speculative openings. BTC corrects to $40,000, $50,000 in a crypto winter, but memecoins like Pepe, and WF offer leverage for agile traders. ETH and SOL lose 40–50% of value, but AI and DePIN projects like RNDR and AKT maintain capital inflows, rising even in bear markets. These scenarios highlight the importance of adapting strategies to market cycles. Investors must monitor macroeconomic indicators, interest rates, inflation, and technical signals, volume, support, resistance levels, alongside regulatory events like the SEC's decision on Solana ETFs. Geopolitical factors, Middle East tensions, and energy crises may also impact demand for decentralized assets. The key is flexibility, using tools like on-chain analysis, e.g. Glassnode, and open interest data in futures to identify trend shifts, balancing security and innovation. While Cathie Wood's vision offers a robust portfolio, market realities demand balance. Giants like BTC, ETH, and SOL ensure liquidity and lower regulatory risk, but niches like AI and DePIN could accelerate wealth growth. Investors must thus balance security and exploration, aligning strategies with macroeconomic trends and technological advancements. After all, wealth in crypto isn't just in established assets, but in identifying innovations before they go mainstream. Projects like Render, RNDR, Akash, AKT, and Helium HNT are redefining tech and physical infrastructure, while AI and DePIN attract institutional capital. Real-world asset tokenization, RWA, and utility NFTs, e.g. gaming, prove decentralization extends beyond the top 3 cryptos. Therefore, the answer to "are 3 cryptos enough?" isn't binary. Giants offer stability, but the future lies in niches yet to be fully explored. The lesson is clear. Intelligent diversification, combining security and innovation, is the path to maximizing gains in an evolving market.